If you woke up tomorrow morning and saw headlines saying inflation is suddenly rising again, global markets are shaking, and investors are rushing toward gold, you might wonder what really caused it. Was it a political crisis, a surprise economic report, or something much deeper happening behind the scenes of the global economy? The truth is that the gold market often moves long before most people even notice what is happening. Hidden signals inside economic data, inflation reports, employment numbers, and central bank decisions quietly shape the direction of gold prices. By the time mainstream headlines appear, the smartest investors have already positioned themselves. And today, we're going to explore exactly how global economic indicators and inflation influence the gold market, and why millions of investors around the world watch these signals so closely. Welcome to the Gold Report, the place where we break down the forces shaping the global gold market in a simple and clear way, so that every investor can understand what is really driving prices. Before we dive deeper, take a quick moment to like this video and subscribe to the channel if you enjoy learning about gold, global markets, and economic trends that affect your financial future. Your support helps this channel continue bringing detailed market insights, and it also helps more viewers discover the Gold Report. Now imagine the global economy as a massive interconnected system. Every day, governments release economic data. Central banks hold meetings. Businesses publish reports. Consumers spend money. Workers change jobs. All of these activities create signals known as economic indicators. These indicators help economists and investors understand whether the global economy is growing, slowing down, or heading toward uncertainty. And gold, perhaps more than any other asset, reacts strongly to these signals. One of the most important economic indicators that influences gold is inflation. Inflation simply means that the price of goods and services rises over time. When inflation increases, the purchasing power of money decreases. In simple terms, your dollar buys less than it used to. And when people begin to worry that their money may lose value, they often turn toward assets that historically protect purchasing power. For centuries, gold has played that role. This is why inflation and gold are so closely connected. When inflation rises faster than expected, investors often move money into gold as a store of value. But the relationship between inflation and gold is more complex than many people realize. Sometimes, inflation rises and gold barely moves. Other times, inflation stays moderate and gold surges dramatically. Understanding why this happens requires looking deeper into the broader set of global economic indicators. For example, one of the most influential indicators in the world is the Consumer Price Index, often called CPI. This report measures how quickly consumer prices are increasing. When CPI numbers come out higher than expected, markets immediately react. Investors begin asking an important question. Will central banks raise interest rates to control inflation? Interest rates are another powerful force that affects gold. When interest rates rise, traditional investments like bonds and savings accounts become more attractive because they start offering higher returns. Since gold does not pay interest, higher rates can sometimes reduce demand for gold. However, if inflation rises even faster than interest rates, gold may still become more attractive because real purchasing power continues to decline. This delicate balance between inflation and interest rates is something investors watch very closely. Central banks, such as the Federal Reserve in the United States, play a major role here. When inflation starts climbing too quickly, central banks may increase interest rates to slow down spending and stabilize prices. But if they raise rates too aggressively, they risk slowing the economy too much, potentially triggering a recession. And this is where gold often finds its strongest support. When economic growth becomes uncertain, investors look for stability. Gold has historically served as a financial safe haven during periods of uncertainty, market volatility, and economic stress. That is why gold demand often rises when recession fears begin spreading across global markets. But inflation is not the only indicator shaping gold prices. Employment data also plays an important role. When employment numbers are strong, it usually signals a healthy economy. Consumers have jobs, income increases, and spending continues. But if employment suddenly weakens, it may signal economic trouble ahead. Weak employment can push central banks to lower interest rates or introduce stimulus measures, and such policies can support gold prices. Another critical indicator is gross domestic product, commonly known as GDP. GDP measures the overall size and growth of an economy. When GDP grows steadily, markets feel confident about economic stability. But when GDP growth slows sharply or turns negative, investors begin worrying about recession risks. During such times, safe haven assets like gold often attract more attention. Now imagine a situation where inflation is rising, economic growth is slowing, and employment data begins weakening. Economists sometimes call this environment stagflation. Stagflation can be especially challenging for policymakers because raising interest rates might slow the economy further, while lowering rates could make inflation even worse. Historically, stagflation periods have been very supportive for gold prices because investors search for assets that protect purchasing power while also offering stability during economic uncertainty. Another important factor influencing gold is currency strength, particularly the strength of the US dollar. Because gold is globally priced in dollars, movements in the dollar can significantly impact gold prices. When the dollar becomes stronger, gold can become more expensive for international buyers using other currencies, which sometimes reduces demand. But when the dollar weakens, gold often becomes more attractive globally. Currency fluctuations themselves are influenced by economic indicators. Strong economic growth, stable inflation, and attractive interest rates can strengthen a currency. Weak growth, rising debt, and monetary easing policies can weaken it. Investors constantly analyze these trends because currency shifts can create powerful movements in the gold market. Global trade activity also plays a role. When international trade slows down due to economic tensions or slowing demand, it can signal weakening global growth. Such conditions often increase financial uncertainty, and uncertainty tends to support gold demand. Investors look for assets that can preserve value when markets become unpredictable. Another powerful influence on gold comes from government debt levels. Around the world, government debt has been increasing steadily. When debt levels rise too quickly, investors sometimes worry about long-term financial stability. Governments may respond by increasing money supply or keeping interest rates low to manage debt costs. These policies can contribute to inflation risks, and again, gold often becomes attractive in such environments. Central banks themselves are also major players in the gold market. Many central banks hold large gold reserves as part of their financial strategy. In recent years, several central banks have increased their gold purchases to diversify reserves away from currencies. These purchases can influence global gold demand and create long-term support for prices. Another key indicator investors watch is the Producer Price Index, known as PPI. While CPI measures prices paid by consumers, PPI measures prices businesses pay for raw materials and production inputs. Rising PPI numbers may signal that businesses will soon raise consumer prices, potentially pushing inflation higher in the future. Financial markets react quickly to these signals. Traders, hedge funds, banks, and institutions analyze economic indicators the moment they are released. Advanced algorithms even process economic reports within milliseconds. This is why gold prices can move sharply immediately after major economic announcements. But long-term investors often focus less on short-term volatility and more on broader economic trends. If inflation continues rising year after year while global debt expands and economic uncertainty grows, many investors believe gold may play an increasingly important role in portfolios. History offers several examples of how economic indicators and inflation have influenced gold. During periods of high inflation in the past, gold often experienced powerful rallies. Investors seeking protection from currency devaluation shifted capital toward physical gold and gold-related assets. However, the relationship is never perfectly predictable. Sometimes gold rises even when inflation is moderate because investors anticipate future risks. Markets are forward-looking, meaning investors often position themselves based on what they believe will happen months or even years ahead. This forward-looking nature is what makes economic indicators so important. They provide clues about the future direction of the global economy. Inflation reports, employment data, manufacturing activity, retail spending, housing markets, and central bank statements all help build a bigger picture of economic health. Technology has also transformed how quickly information spreads. Today, investors around the world can access economic reports instantly. A single data release can trigger reactions across stock markets, bond markets, currency markets, and the gold market within seconds. But despite this speed, the fundamental reason people turn to gold has remained the same for centuries. Gold represents stability. It is not controlled by a single government. It cannot be printed like paper currency. Its supply grows slowly compared to fiat money. These characteristics make gold unique in the global financial system. As global economic indicators continue evolving, investors will keep analyzing inflation trends, interest rate policies, currency movements, and economic growth signals. Each new report adds another piece to the puzzle of where the global economy may be heading. And that is why discussions like the one we have today on the Gold Report are so important. Understanding how these indicators interact helps investors make more informed decisions rather than reacting emotionally to market headlines. As we move forward in the coming years, inflation dynamics, global debt levels, central bank strategies, and geopolitical developments will likely continue shaping the gold market. Some periods may bring calm and stability, while others may bring volatility and uncertainty. Through all of these cycles, gold remains one of the most closely watched assets in the world. Now, I would love to hear your perspective. Do you believe inflation will continue rising in the coming years? And do you think gold could benefit from that trend? Share your thoughts in the comments below because your insights always create interesting discussions among viewers of the Gold Report. If you found this analysis helpful, consider sharing this video with someone who follows financial markets or invests in gold. Conversations about economic trends become even more valuable when more people join the discussion. Thank you for watching the Gold Report, and I will see you in the next video.